Good weekend, all. Ira Epstein of Linn and Associates with your metals market update, your weekend edition for this Friday, the 8th of March, 2019. We're just getting on to 3 p.m. Central Standard Time, and what a wild day. It started off, of course, with the poor jobs number in the U.S. 20,000 added when the market was looking for 180,000. So that was a shocker. Is it a one-off, a fluke? We don't know. But I can tell you, look at how the market has come roaring back off the lows. As for the gold market, it came back. Everything broke off the report initially. Look at how these markets, silver, gold, came rushing back. Now, the bad news is that our ambassador in China was talking today and saying that he doesn't see any movement on the Chinese part getting ready for any meeting at all with the Trump administration at month end. I don't know who's a good guy, bad guy routine, but that is problematic for the market. The dollar index has been a powerhouse all weekend, and going into the end of the week, we're seeing that the market has done what? Reverse that a little bit, and the other currencies coming up a fraction. And of course, during the week, we saw that Mario Draghi, the president of the ECB, said there's no interest rates on schedule, a hike for the Eurozone this year. Whoa. And lowering growth rates. So the question is, in the metals, is the metal market starting to think that word more stimulus can mean more inflation? The Fed, you know, only a 20,000 job hike isn't moving the Fed. It's not like a blowout 300,000. When you come to the monthly chart of gold, I think you'd agree with me. We have been sideways in this market for years. Certainly, since the end of 2015, we have been going in this channel marked by the black Bollinger Bands. Bollinger Bands are an algorithm designed to keep the market trading within them 95% of the time. When you eventually break out to the upside or downside on a daily chart or a weekly, you're going to get overbought. Just how it works. But you've got to understand, this is like a spring inside of a pipe. It's winding itself up, and eventually the price breaks out. When we look at the weekly area chart of closes, which means we're not looking at the highs, lows of what happens during the week, we're looking at settlement prices. You've been in a bit of a down thrust. In fact, you're in a down thrust since you closed at 1329.20 back at 1300. But you're still staying over the 18-week average of closes, so at best, this is a pullback in the market, not a differential of the bias to the upside. When you take a look at a weekly bar chart, you spike to a high of 1344 as an intraday high. You're in a pullback mode. You can see that you've stepped out of the trend. The trend was broken when you took out this low of 1301.60. How do I define trend? I define trend, whether it's on a monthly chart, weekly chart, daily, as a pattern of having higher lows and higher highs. I wrote a formula years ago called a swing line, many years ago, probably 20 nearly now. And I wrote it because at that point, my son, who was in his teens and he's now in his 30s, I said, I bet I can teach you how to chart anything you want and show you the risk with it. And that's what it did. If you break 1301.60, you've broken the trend. So here the market comes down. What was the risk? Well, if you were buying the market way up here at 1329.70 as an example, your risk was back under 1301.60. So you can measure the risk if you break that pattern. It's simplistic. But what I have found over life is the best ideas are simplistic. Coming down. So you stepped out of the trend last week, and this week was a follow-through that at the end of the week found itself rejecting that it didn't want to stay down dramatically. When you look at where the market was going, I was wishing, hoping to see the market go down to the 100 and the 18-week average, because that would be classic in terms of finding a support. You're close. You got down to 1280.80, the low of the 100-week average is 1274.20, and the 18-week average 1273.80. You're in an area of support. The bias is still up, but you're not trending on a weekly basis. In terms of the Bollinger Bands, they've done a very good job of letting the market pull back. When they get up to it, they pull back again. The idea from a Bollinger Band is staying over it's only going to be 5% of the time. So what I teach is that the first time you hit that band, it is not uncommon for the pros to take some money off the table. That doesn't mean it can't go higher. It's just that if they got out there, they might be able to come in at a better point, maybe a lower number. I don't know. A lot of it has to do with momentum. And as you look now you're getting divergence in the market to a degree. Let's explain that. First off, you can see that your momentum back here as of February 22nd was just locked in going sideways. That was bullish. You then got the red line closing back here at 78.68. You see the number right there. So now it's turned down. When that happens, momentum often leads price. And what that did is it broke the price down. Now we still see momentum coming down here. So the question is, in an ideal trade situation, momentum locks into a direction, price moves into that direction with it. You've got divergence right here. In the gold-silver ratio, silver-gold ratio has rallied back into an area that it's had trouble with on numerous times. And you can come back here and just take a look. Since last year, August, when the market got into this 86 zone, the market has had problems. So we're back to the area where I would assume that the gold-silver ratio is back into a resistance area. That doesn't mean it's trending in favor of silver. It's just you got up to the point where the gold-silver ratio, which favored gold, has run into resistance. When we step into this chart, and this will be the GLD chart, you can see how this market fell like the futures. It got much closer to this 100-week average, and it's giving you a spin today back up and away from that. So for the week, you're going to be up about $1 in the market, and you didn't quite make it to those numbers. Like the futures, you have momentum pointing down. The bias is up because you're over these numbers, and you've lost your way in the trend, just the way you did in the futures contract. When I come over to GDX, it's the same thing. This is the gold miners. You can see how the market lost its upside momentum, putting down. It did the same thing as we saw before. It had resistance, first at the 100-week average in the Bollinger Band. Then on the pullbacks, it kept finding support at the 100-week, got to the upper Bollinger Band. Let me just show if I can get this to do it. I'm going to come here and see if I can get it to come back one day. That's what I wanted, 1 week. Last week, it pulled to the 100-week average. I know it slid through it this week, but it came back over it by the end of the week. Not bad action. This market, none of these markets are falling apart on you. They got a bit ahead of themselves, and now it looks to me like they're trying to figure out what next. In the silver market, this is what I, as a technician, wanted to see. The market had turned down here with lower highs, then lower lows. The key was, could it stay and get under that 18-week average? Momentum was already down, the bias was up. You got under it, and today you come roaring back, and if you settle like this, you're over it. This was what I'll call a successful test at this point of the support offered by the 18-week average. You're still going to have divergence, but in terms of lower highs, lower lows, trend down. In terms of momentum, correcting, when these numbers get under 70, which could happen as early as next Sunday night. If that happens, you're no longer in an overbought condition, and with the market closing over the 18-week, it'll take time for this to develop a pattern. But if you rallied, where do you think resistance is? I'd argue it's the 100-week average. It's shown itself. Where's the support? The 18-week. In the copper market, we know that things between China and the U.S., the trade talks are going on. Whether our ambassadors got it right or wrong, I don't know. But I can tell you as a chartist, higher lows, higher highs. The first challenge of trying to move the market out of this sideways action, that's what we should look at. Up to the 100-week average, upper Bollinger Band, pulling back a little and inside the Bollinger Band. That's not bearish long term. This market is still on a longer term basis on the weekly charts in an uptrend. The momentum has not turned down and the bias is up. In the platinum market, we pulled back from the upper Bollinger Band. I think you'd agree you've got pretty much sideways action there. If you break down, I'm going to look for support at the lower band. If you rally up, resistance at the top band. Market goes to the top band. One of the things that you'll hear me say on these tapes all the time, videos is the right word, is this is what I call the line in the sand, that 18-week average. When you're above it, it's not uncommon to pull back to it for support. You don't have to, but it's not uncommon. The market pulled back to it this week, and it found temporary support at it. We'll see where it goes from there. What is the trend? A lower low and a higher high. It's not trending. It's still staying within the sideways action. The strongest of the metals on the weekly chart remains this, the palladium market. You still have the pattern of higher lows, higher highs. Gets to the Bollinger Bands, pulls back, keeps going. That's been the pattern for basically, friends, since October, believe it or not, when this market broke out of this overall sideways action. Hasn't looked back since then, and away it's gone. In the dollar index, I want you to look at the Bollinger top and what's going on here in the 100-week average. That's been the support, and you're still very much sideways. Yes, the dollar is in an uptrend. Yes, it's at resistance of the upper Bollinger Band, and yes, the bias is up in the market. Dollar still looking good. What if it breaks out of the top side? You can get over 100. So until you get something else happening here, taking out, let's call it the 95.71 level, the bulls have grabbed control on these charts. You know, I love to teach, and I love to tell you the problems I have sometimes, because you probably have the same thing. You know, trading is a lonely, lonely thing. I put out recommendations for my clients. I tell them what I think should be going on, where things are going, blah, blah. If you think that I don't die 1,000 deaths when you do that, you are sadly wrong. You do. I might be having a drink of whiskey at night, who the heck knows. But the point is that in the mornings, what I do is I come in, I get up a lot earlier than most people. I'm already, by the time I'm in the office, I've read Reuters, Bloomberg, CNBC, I've seen all that. But I've updated my charts, and at that point, I start talking to you as though you and I know each other. And I'm going to talk the chart action, 40 charts at a time. Now I'm up to probably 43 because I've been adding ETFs. I had a customer that wanted QQQ, so I said, why don't I add that? I think today it was XLE or one of them I added. I added the energy, so I'll add a few more of these. I don't want to do 100 charts in the morning, but maybe I drop some others. We'll see. Make the story short. Why not cover the ETFs just like the futures? A chart's a chart, a chart. That's how I look at it. So I cover the chart action. I'll tell you what I think a pros would be doing at these different points on the charts. I'm going to talk some of the technicals and fundamentals. Very short on the fundamentals, but I will go there. Like I'll talk about today's employment data, the impact that it first had. And I am going to throw out trade ideas at you. And I do it ice cold, which means I'm not worried because I don't know you. I don't know your positions. I don't know what you've got. But let's assume you're trying to put on something. You want a market position. Well, maybe I'm saying the same thing you are. That could be what you need. What if you're wondering, gee, I want to put that on. I don't know. And here's Ira, he doesn't like what I'm doing there. Maybe that helps you. I don't know. The idea here is I know how important it is that if you respect somebody, and that's the whole key here, if you respect what I do and you like what I'm doing, then why not take a look when I'm able to really open up and say, buy here, sell there, do that. That's the difference. I'll stand behind what I do. The whole cost, it's inexpensive. 26 cents a day, $7.95 for the first 30 days, and no, there's not a big kicker. A lot of people want to do it on a yearly basis. I go to $13 a month, which is $156 if you buy a year at a time, or $15 a month, and yes, you can stop at any time. To get it, you can either call my staff. The best way to do it is just go online, right where you see there. You can also click up here if you're watching. It'll take you right to the page. You go, if you're online, it'll be under education or research. Go to morning subscriber video. Love to see you sign up. I'm Ira Epstein. Give it a try. Talk to you Monday.